Well, good evening, friends. If I can encourage you to come on into the main section of the building and grab a seat. There's plenty here up the front. Welcome. It is wonderful to see you all here. And whilst everyone in the building is taking their seats, if you're at home watching online, welcome to you. We hope that you are encouraged by being with us virtually tonight as well. For those who are relatively new to our church community, my name is Mike Smith. I'm the minister here at Minchinbury Anglican Church. We say that our church exists to love Jesus and to show Jesus' love. That is why we're here. We want to be known as a group of people who love our local community and want to support our local community in lots of different ways. And one way is just in the practical living day to day, and of which finances and mortgages and homes and all of those kind of things are part of everyday life, and we want to be able to provide resources and help and support to not only our church members but to our local community in that space as well. And it's a great privilege to have Peter and Beth Comino here tonight, and Peter will be presenting most of our session tonight, and there will be an opportunity to ask questions, and I'm sure Beth will join Peter in due course and help answer any questions that you might have. Peter and Beth have been members of our church for a little while now and come regularly to our morning congregation. And they have a business called Home Affordability Solutions, a business designed to help the average Australian with property and mortgages and things like that. You can see there on the screen the three core values of Haas: hope, dignity and security. And for those of you who are members of our church, those core values ought to resonate with you because they are significantly similar core values to the Christian life and Christian community. That we want to be known as a church that offers hope, dignity, and security. Security, yes, now, but more importantly for eternity. And these are the core values of Home Affordability Solutions as well. So I'm going to invite Pete to come down. Why don't you make Pete feel very welcome as he shares with us all things shared equity tonight.
Thanks, Mike.
Thanks, Pete.
Thank you. Hello, everyone. Welcome, and thanks again, Mike, for opening up the church to us. So Mike was talking a month or two back now about finances and how important it is to steward our finances well. And I looked at Beth and I said, do you think he'd be interested in us talking about our product? Because we're all about helping the average Aussie. And just to let you know, so I'm own the business with my wife. I'm the simple guy in the company, so if I don't get it, you won't get it. So I'm trying to make the shared equity as simple as possible to understand. So we'll just jump into it. As Mike said, look, our three core values are hope, dignity, and security. So what does a home provide? Security and dignity, and we are the hope because there are, I think the stat that I've read recently is that in Australia, there's 30% of those aged between 18 and 30 or 18 and 35 believe they genuinely won't be able to afford a house. They've just given that up completely. So our product is all about there is hope, okay? So I kind of want to jump into the problems that we're facing at the moment, what shared equity is, how we solve it, and we can ask questions at the end, kind of thing. So I want to jump into the kind of the story, and that is that a while ago, interest rates were very low. They were record low, and people were, you know, see where that bar begins in December 20 to April 22. That your interest rates were at a record low, and a lot of people were buying property then because they could service a loan. Right, the banks were happy to lend money. All right, but 3 years later, we've got 12 interest rate rises, and basically the people that bought back there on the beginning of the graph there, they were only calculated by the bank to be able to afford right where that arrow is in February 2023, where the rates hit, and every rate increase since then. The bank, they weren't calculated to handle those interest rate rises. When interest rates rise, the more you have to pay on your mortgage. Okay, so there's a lot of pain out there at the moment for people. All right, so on top of interest rate rise, you've got increased house prices going up. So a lot of naysayers out there are saying, just wait till they drop, just wait till they drop, just wait till they drop. They've been saying that for years, but they actually keep going up. And they're even with current forecasts are that even with more rate increases, the house prices are still going to go up. All right? And there's that stat, a third of Aussies between 18 and 30 believe they'll never own a home. So there's a lot of pressures at the moment. All right, pain points. You just go on social media. This was just off Facebook and any kind of finance self-help groups. People aren't really going to people they should to ask questions. They're going to Dr. Google, which is probably never a good thing as far as your health and your financial health. But a lot of the problems that they're facing are, I've had to get a tenant in, a uni person to come in and, sublet part of the house. Is anyone else finding it difficult just trying to ride through the interest rate storm? It's all over the place. It doesn't take long to find. All right, so I'll jump into some of the problems. The cost of living problem. So Mark and Ella, married with 2 kids, they bought 3 years ago. Their fixed interest rate was nice and low at 1.99%, right? Their monthly payments on their mortgage, $2,000. You fast forward 3 years later, that rate is now 6.24%. What does that mean for them? Their monthly payments have doubled. Okay, so they're having to find $2,000 extra a month. Plus, with the joys of inflation, you've got groceries up, you've got energy bills up, I think in some cases 50%. Petrol up, look, everything's going up. All the bad things are going up. So there's a real issue there. And then you've got the people that are stuck in the rent trap. Okay, so let's, Sally, for instance, she wants to buy her own home. Now, traditionally, you would save up 20% of a purchase of a house and to put a deposit. And the reason for that is something called LMI. And what is LMI? It's lender's mortgage insurance. So when you start to borrow over 80% towards going to your house, banks don't like that because banks don't like risk. So they will add extra money onto your loan because you're taking more risk. So like if you need to take out a 95% loan, you'll encounter this thing called LMI, and that adds thousands of dollars to your mortgage, okay? So that's why traditionally you save up 20%. Now, the problem with saving up 20% is it takes about 10 years to do that now, especially in Sydney. It's actually 11.3 years on average to save up for that 20% deposit. So meanwhile, you're saving up every year and the house prices continue to go up. You're paying rent, so it's dead money, or you're living with your parents, and there's a term for them called kippers, so kids in parents' pockets eroding retirement savings. So you're there into your 30s, sometimes into your 40s, just because the way the house market is and trying to save up. Okay, so what is shared equity before I go into how we solve these? So shared equity involves an equity partner contributing money to help purchase a home. So it's a solution which trades lower monthly payments and a lower interest rate for a share in the capital growth on the property. Our equity partner is a public residential property trust, and I'll talk more about them soon, but that is shared equity. Okay, the public property trust is Storehouse. Storehouse manages a portfolio of residential properties. It's funded by a pool of investors, and it's got backing by KPMG auditors, which are well known. It's a listed ASX company, which is a trustee. It's bulletproof. So where does HAS fit in the whole thing? We're in the middle. So you've got your broker there on the right-hand side of your screen and you. And we sit between them and Storehouse, and we organize kind of the funding. We go to Storehouse and say, hey, there's a suitable applicant here. Storehouse provides funding, and we contribute that towards the loan. And the broker is working with you on the lending side, getting the right, can you service a loan, etc. Okay, so back to the problem. Here we go. If you remember Mark and Ellie, so let's say they have a mortgage of $700,000 already, so they've got a home, but they're struggling with that interest rate and the payments. So how does shared equity help? So we take on fund a portion of the loan. So what happens is we split the debt. So instead of that full $700,000, 80% is now with your first lender, your bank, whoever that is, your CBAs or whatever, and the shared equity takes on 20% of the debt. So what does that mean for you? That means on that 20% portion, let me use the laser pointer here, over here, the interest rate is 3.25% with us for interest only, fixed for 5 years. If you guys know the interest rate at the moment for any of your banks, it's usually in the 6s or the 7s. So 3.25%, very low. But also, the first 3 years of this facility is paid for. Monthly payments are paid for, are covered in the shared equity facility. So essentially, what does that mean? You're only paying for the first 3 years with us, monthly payments on this reduced 80% of what that was. Okay, so that means lower monthly payments. So in the example of Mark and Ellie, when we run it through our calculator, $1,700 per month you're saving, which adds up to $20,000 per year. All right, so let's go back to Sally. Sally wants to get a home, okay? Remember I said the 20% deposit you try to get to avoid LMI? That if she's going for a house for $900,000, her deposit needs to be $180,000, okay? And again, you're saving a long time. You're going from rental to rental, which isn't fun. I've been there. You're constantly living out of boxes. You feel trapped. So how do we help? So with shared equity, when you're purchasing a home, all the client needs to come up with, the customer, is a 2.5% deposit, and the shared equity boosts them 17.5, and that reaches that 20% threshold. So essentially what you need to get as a homeowner, or your kid, if you've come tonight, you're a parent, you're wanting to know how this works. If your child is looking for a home, all they would need in this situation is $22,500 instead of that $180,000 deposit. Okay, what it means is they skip the LMI, so there's not that risk fee. Again, the interest on the shared equity portion, 17.5%. It's very low, 3.25. And again, first 3 years of which are covered. So what we say it has is, get in now, into the property now, instead of waiting on the sidelines for 10 years. Get in now and share in the capital growth. Okay, so what is capital growth? What are you sharing? Okay, let's say you bought a house 3 years ago at $1 million. It's now $1.2 million. Your capital growth is $200,000. That's the value of your house gone up. You are sharing a portion of that with the trust. So usually it's typically about 20%. So with the trust, you'd be sharing, I think it's about $40,000. You're pocketing $160,000, I think, off the top of my head. That's the share in the shared equity. Okay, so how do I qualify? You need to be able to service a loan. The first mortgage and the second mortgage, we do the calculations for you. So, that's what you would work out with your broker as well. But we also run it, your service kind of twice, your broker and ourselves, just to make sure. And so that's kind of normal bank process there. So you need a good steady income. You need a good credit score. And then a priority by our equity partner is that those who make a sponsored investment into that trust, that storehouse, are given priority for shared equity. And I'll go into that in a second. The deposit, you need that 2.5% if you're buying a house. Obviously, that doesn't happen if you've got a loan already and you're refinancing. So you need to be able to service a loan, and priority is given to a sponsored investment into the trust. So what's the sponsored investment into the trust? First of all, where can sponsorship come from? It can be your family. There's mom and dad there. It can be friends, community. It can be you. It can be a combination. And so this is where kind of the uniqueness of the shared equity as well comes into play. How can you be your own sponsor? Well, our partnership with Storehouse, which is a public property trust, means it's open to superannuation. It's a suitable investment. But that's entirely the matter of the sponsor, whether that's you or you folks, and their financial advisor. So a requirement of investing into the trust is a financial advisor needs to sign off on it, and Storehouse can put you in touch with financial advisors. Okay, what does it look like? Like I said, your sponsor can be you, family, friends, community group. It's usually one of two things. It's cash or superannuation. It can be both. and that investment is made into the trust. All right, the big picture, how it really looks when it all comes together. So there's kind of two sides to it. You've got, let's take the parents and the kids angle here. So let's say it's your child wanting to get in and you want to help. The way your mom and dad would do, they make an investment into a storehouse, and they would fund that 17.5% portion. They would put the investment in the storehouse. They would nominate a property to add to the portfolio of houses. There's about 200 houses in the property trust portfolio. And what Storehouse does is they boost. They give has the funding and has boost the deposit at 17.5%. So what the child is finding is just that 2.5%. It's boosted by 17.5, and your bank, your first lender, is doing the 80%. And that's what goes into the funding for the house. So you have to see two different sides of what's happening here. You've got the funding side, and then you've got the investment side on the left. All right, and bigger picture of how a refinance or a purchase works. So again, the biggest difference is with a purchase, you need that 2.5% deposit plus the 17.5% boost with your sponsor investing into the trust. Again, that can be you, it can be family. Or the refinance, it's the full 20% into the trust and then works with the 80% lender, and then you get the loan or the house. Now, I guess it's important to note before I go any further, why would your mom and dad do this? Because there are other options. Parents can do something called a family pledge, where you put some of your house up, your current house as security, or you're able to, many parents can help with a gift, but it has to be kind of a once-off gift, very big gift to help them with that deposit. And sometimes there's an awkward conversation with your child about, are you ever going to repay this? And I think you have to assume it's kind of dead money because we're parents. But how many times can you do that if you've got 4 kids like I do? If you do one for the first kid, the others are going to come up to you later and do this. So the way it was really founded, our Storehouse director is here tonight, and he founded the whole idea. He had 4 daughters and thought, how am I going to get them into houses? So he has an investment banking background, and that's where his skill set was. So it was a way of parents helping their kids and de-risking, taking the risk as much out of the whole process, the family pledge process, and putting up the gift money and not having it returned. So basically, investing into the trust, you're investing into a portfolio of houses, not just one house. And when your kid is done, after 3 years, we encourage you to refinance. But you can stay in it for 30 years. It's up to you. But we encourage you to refinance. When you refinance out, you pay out the has shared equity plus that shared equity growth, where I talked about, that percentage of the growth. The parents can go again. Their investment is still sitting in the trust. It's no longer, it's always been sitting there, but basically, once their child has refinanced out, then they can help number 2, and then number 3, and then number 4 with that same investment. So you're not having to go find another 100,000, another 100,000, another 100,000. And on the investment side, they're getting a yearly distribution, a return on their investment. So think of your superannuation now. Most of you, if you're anything like me, probably don't know what's happening with it, even where it is. Maybe it's spread across a couple super, ART or Australian super or something. You don't even know what it's doing. It's in the parents' investment. If they're using their superannuation or cash, it's sitting in Storehouse. They're getting a return on it every year, just like it, with an Australian super. Okay, so some success stories. The names are loosely based on the actual people. We've got Gal, bought a house and land package. I have to look behind me because it's still too small up there. Bought a house and land package for $700,000. Sold 3 years later, $1.3 million. That's their capital growth. Their gain was $600,000. Their whole goal was to buy a house outright and be mortgage free. They were actually able to do that. And so basically the huge success story here, with just a 2.5% deposit to begin with, they were able to pocket $480,000 after 3 years. That was their the capital growth. They couldn't have done it without Has shared equity. They kept their investment in the trust, so they were sponsoring themselves. Okay, they used, they were able to sponsor themselves, so they were on both sides of that diagram, remember? And they're happy with the returns. They actually got better than what their super was. I don't know who it was with. Might have been with Rest. Can't recall. Which had a negative that year. But they had the Storehouse has got a good return last year, and so they've just kept it in there. So a massive success story there. PAMI, we actually help a lot of divorcees because so that's where the hope comes in again. Obviously, a horrible thing, divorce. And PAMI, especially hard usually on ladies because sometimes they're not working through parts of the marriage. As you know, they're having kids and, just that's the way life works. But she was looking to start over. She was actually caring for the 2 kids. She had a good paying job, but she thought, look, I'm never going to get in the housing market again. She was with us. All right, she was able to sponsor herself. And basically, her feedback was too good to be true when she first heard about it. So that was a really happy story for us. I guess just jump into questions. I'm sure you guys have a lot, but I might just go back to this screen here. Yeah, to help explain. I'm open to questions. Like I said, I'm the simple guy, so if I can't understand it, my wife's more complex in every area, and she'll be able to help me. But happy to field questions if anyone has any. I think Chris is going to go around with the mic. Thanks, Chris. Please just put your hand up. Happy to take questions. But afterwards, we have a table down the back with some brochures. Please take some away. We'd love to get your name as well and email if you can to for one of our people to contact you, and we can take it forward from there just to see what your situation's like, to find out more about the product, see how much you can borrow with shared equity, see the amount of sponsorship you need. We can take next steps, really. So, yes.
Okay, I have a question. So, with the sponsorship, whether it's you or your parents, are you saying that you could take the super money you already have and you would just move it from wherever it is into Storehouse, and that covers the sponsorship aspect, and then you're just needing the 2.5% cash?
A long story short, yes, but the way you would do that, Storehouse would put you in. Storehouse would speak to you on the investment side, if it's going to be, or your parents, whoever. They would need to talk to Storehouse. They put you in touch with a financial advisor. The financial advisor needs to sign off and say, yes, this is a good investment. What would happen is, yes, you'd be essentially rolling over your super into an SMSF. The SMSF invests into the trust. But long story short, yes, your superannuation goes into the trust, and that's the investment covered. So, and then the trust funds the 17.5%. It can be even more, be 20, 30%, if you have the sponsorship available. So all you would need to find on the lending side is the 2.5%. Plus costs. Costs are stamp duty, things like that.
But as in, it means people are able to fund that portion through their current investments rather than having to have the cash randomly set aside to put towards it.
Yes, with their current investment. Yeah, they're able to that's right, they're able to sponsor themselves, correct. In fact, we find that most of our clients are their own sponsors. Yes?
Normally with self-managed super funds, there's very strict rules around you can't benefit from the investment like that, and yet you can.
Well, this is not a bear trust.
Okay.
So that the SMSF side is called a bear trust, so you have to set that up, and there's a whole bunch of rules around that. You're right. So you're not allowed to live if you're buying a property through your SMSF, you're not allowed to live in it. You're not allowed to, I think, do anything to it, from my understanding. There's a lot of rules around it. But what your super or your SMSF is investing into is the trust. And the trust then funds the shared equity. All right. So those rules are, it's not a bare trust anymore. You're as far as you know, your SMSF is just sitting in the trust and it's accruing the yearly dividend. Like it would, whatever you want to do with your SMSF normally, you would want to, I think I can do a better job than Australian Retirement Trust. I think I want to choose to invest in growth shares over here, or the, commercial property over here. Well, you're putting it into the trust. Yes, hold on. Peter Delaney, you want to add something?
Yeah, that's why you go to a financial advisor, to make sure that
Yes.
you comply.
Sorry, Peter Delaney's our storehouse director. So if you have investment questions, parents, please ask him tonight. Thank you, Pete.
So can I answer a little bit
Yeah,
more?
that'd be great.
Okay. Storehouse is a public trust. Okay, that changes its character. A public trust means that it's got more than 200, well, more than 100 investors as a public trust. It's got more than 200. That means it's got to be audited every 6 months. It's got things called continuous disclosure, etc. So that's why it qualifies as a suitable investment for superannuation. So you're literally going, I want to allocate some money to residential as distinct from shares, and the financial advisor goes, is that a suitable thing for you to do for retirement purposes? So the question is residential a good investment for a long-term investment? And most people think that is a good investment. Okay.
Thank you. Does that make sense? Sure. No, that's fine. Yeah. Anyone else?
What happens?
Yeah, go for it.
What would happen if something changed in the market that Storehouse is invested in, such that a lot of properties reduce, fall in value rather than grow?
Sure. So there is a requirement, it might get a little bit detailed here, but there is a requirement that if you want to refinance at that we have a 3-year minimum term with shared equity, so you're with us for 3 years minimum. And there's a requirement with the trust that when you refinance, the trust is assuming there's at least a 10% growth on your property. So when you refinance out, you are calculated at that 10% growth. So that is how to help on the investment side and make sure that there's that yearly dividend coming. Because when you refinance and you share in that capital growth, remember I said typically 20% of your capital growth, it's not going to us. It's going back into the trust, and it's shared amongst all the investors, the mums and dads, or the people that are sponsoring themselves. So it's not going back to us. But that's kind of the risk mitigation there. When you refinance, you are paying it. The calculation used is there has to have been assuming there's a 10% capital growth. So that's how it's handled.
It just sounded like you were saying prices keep going up.
Yeah.
And I was thinking, well, what happens if they don't?
Right.
If the bubble bursts, if you like.
So I guess that is essentially that is a risk. What happens if it tanks? Yes, that is a risk that you're taking with, I guess, any property investment. Whether you own a home now, what happens if your property goes down in value? It is a risk. We try to mitigate that as best we can on the storehouse side, the investment side. But what we've seen is house prices just keep going up. Oh, you still have a house, yes.
So then if the market's going down, you just stay with the system, you still have a house,
Yes,
you're still better
yes,
off than if you were renting,
like you
theoretically.
would with a traditional loan, you're still making the monthly payments. Yes, the house is not the only time it is, if you get into default mode, I think with a traditional loan, you're not able to make your payments, and then you get into some, what do they call it? There's a plan to help you. Hardship, thank you. Hardship cases, the banks would put you in a hardship case. That's the kind of route you go down. But as long as you're making payments as normal, then yeah, that's no problem there. Yes.
Yeah, I was just going to ask, in that scenario, sort of up at 3 years, where the capital value of the property has decreased, and there's a 30% refund, back to house, back to the storehouse. How does the first mortgagee feel about that?
Well, the lenders that we use, we can't use all lenders because some lenders don't like a second mortgage because that's what we are. So we have approved lenders that we work with. There's 3 in particular at the moment. So they're absolutely fine with it. Yeah, no issues with it. So not every lender will accept a second mortgage. So I hope that answers that question. We use the ones that do.
Peter, can I just add, we actually do a deed of priority, so the first lender gets priority. So when you're refinancing, they get paid out first, and then whatever's left goes to the shared equity facility. So they're quite happy because they're looked after first.
Thank you. James, was that good? Okay, mull it over. All right. Yeah, go for it. Sure. Sorry, what's your name?
Peter.
Hi.
So Peter.
Hi. Lots of Peters in the room.
Just re-explain this I don't quite get this, what's happening in the 3rd year.
Okay.
And, because you can't liquidate the thing you're living in, but how are you liquidating or getting the capital growth out of the refi? Just explain that out a little bit more.
So you've hit the 3-year mark.
Yeah.
You want to refinance at this point.
Yeah, so it's gone from 1 million to 1.2,
Yep.
sticking with that model, right? I'm refinancing for 1.2?
You're refinancing for, so I might turn to Beth. Help me out here, Beth.
Yeah, okay, so you're refinancing the 2 facilities. So you're refinancing that first mortgage, that 80%. So after 3 years, you've paid off part of that mortgage. So what we actually say is, because we've got the first 3 years of repayments in the shared equity facility as well, we've serviced you on the basis that you're making those repayments from day one. So we tell everyone, throw that in that first mortgage, reduce that principal as much as you can in that first 3 years. So when it comes time to refinancing, you've got your balance of your first mortgage plus your shared equity facility. Now that's been interest only, so it means that it hasn't changed in value, that base shared equity, and then you're doing the capital growth. So you're hoping at that point that the combination of the 2 are sitting at an 80% LVR, so loan to value ratio. And that's how you're able to refinance and consolidate the 2.
And the mortgage too?
Yes. So rather than having the 2 mortgages, you just have the 1. You consolidate the 2, so you completely refinance the whole facility, both things.
So we try to see the shared equity as a bridge, really, for those first few years. It's like a setting phase, a building phase for a family to help you in those first few years, especially those first 3 years. And like I said, you can be with us for 30 years, but most people refinance at 3, 4, 5 year mark. We don't have many more after that. You can, but it's kind of the bridge to help you get to, with us. It helps you the lower monthly payments for those first 3 years, the lower interest rate. Then when you refinance out, you're getting rid of the second mortgage, putting it all into the first mortgage. So it's like, it becomes almost like the traditional loan then.
And keeping a return for the actual people that are in
Yes, they're getting, and if that's you, it's totally up to you what you want to do. If you're sponsoring yourself, you just keep it there, keep getting a return. Or we find that some people are going again, they go, oh, you know what, I got into the property market. Actually, I'm doing quite well. I want to get an investment property now. And they use that same investment and they go again, they get an investment property. So again, what you want to do when you refinance and you've sponsored yourself, it's up to you. You can keep it in there. You can go again. Or like I say, if you're a parent, you've done one child, you want to do the next one, you get them ready. I'm able to help you. And wash, rinse, and repeat kind of thing. So. Yes, sorry.
I don't even like a bit planner. So just working on that model again, 200,000 is that storehouse portion at 2.5%, which you're not paying. Your storehouse is servicing that 2%.
No, the 2.5% is what your child or you need to come up with to put the deposit down on a house. So we're not doing 100% loans.
But what's the interest rate on the 200,000 that you're getting there?
So the interest rate on the storehouse, on the HAS shared equity funding is 3.25%. Which for the first, it's serviced by that shared equity facility. Yes, you're not paying that for 3 years. It's paid for. Your monthly payments are actually included. Do you want to exit or do you want to stay? Exit meaning refinance. Because you. Do you do catch up? Sorry.
Can I jump in?
Oh yeah.
So
Go for it.
the 3 years repayments are included in the shared equity facility. So we've already covered them for you. So it's not that you have to make up for the last 3 years of repayments. They're already included. So in that 4th year, you'll start making the repayments yourself if you don't refinance. But it's still sitting at that 3.25%
So they're lower, yeah.
interest only.
Yeah.
Yeah, and it's fixed for 5 years at that interest rate.
So we are finding that some of our clients that have rolled off the 3 years and they're coming in, they're now making payments on that shared equity portion. They still want to stay with us because it's a 3.25%. For them to refinance yet, it might not have. Yeah, but we're actually we're not finding that a big deal because prices just keep going up. Yeah. Yes. Yep. Yeah.
To give my experience, because I don't understand the housing market terribly.
Sure.
So once you've been through the 3 to 5 year plan at the fixed rate, is it best to stay at a fixed rate or talk to a financial advisor whether to go variable rates? Like I heard a lot of that discussion, around fixed and variable. Is there preference either which way?
Sure. Well, your broker should be helping you with that too. So people going to Dr. Google, not great. Your broker should be the person you trust. Get a good broker, and we can put you in contact with accredited brokers. We got plenty, and there's one here tonight as well. But they would be able to advise you. But absolutely, financial advisor can help you. And if you're the sponsor, then we would have already put you in touch. Where you would already have a financial advisor because you can't make the investment into the trust without one. But yes, you would talk to them or your broker. They'd be the ones, they'd advise you best. Yep. Sure. Okay, well, look, I'm happy to take questions, but you've got Beth, obviously, to help. You've got Peter Delaney, Director of Storehouse, here to help for parents, especially who might be interested on just the investment side of things. Got one more question?
Yeah, just one. So obviously you can sponsor yourself or your parent can sponsor you.
Yeah.
But presumably anyone could. A friend could.
Yeah.
Yeah.
Absolutely. Friends, we've had builders be sponsors as well. So it's kind of a sneaky way of them saying, oh, we'll reduce the price, but they're not. They're making investment into the trust. We've had bosses that want to encourage company loyalty. They actually become part of the sponsor as well and saying, like, if you work with us, we'll help you get a house. So anyone can. Yes. Yes.
So I can say this. Good. You know, what we're finding is grandparents are hanging around longer and they're helping out as well.
Yep. Yeah. So anyone. Yes, the sponsor can be anyone. Anyone. No, if you have more sponsorship available, then that's all the better. Because let's say you can actually fund 30%. Then that means the first lender is now 70%. And that means you've got lower interest rates because there are bands. You know, if you can get for loan to value ratios, they call it. So the size of your loan versus the value of your house. So if you can get in that 70% LVR range, then you have better interest rates. And that means lower monthly payments. Well, it depends, but I know that the return for financial year 22, or was it 23 pad, was 8.65 was the return. Okay, thank you. And that's a flat market, 2%. Yeah, so. Okay.
The whole point of this is to help people are like freaking out. They're never going to get it.
Well, we've been around for 13 years now. So it's tried, it's tested, and the whole aim was to help. Originally, it was aimed at mums and dads to help their kids to get in. But we have found that because it's a public trust, it's a suitable investment for superannuation, so you can sponsor yourself. So most of our people are sponsoring themselves.
So our parents actually buy the house. Bank would pay, putting a mortgage would be smaller, bank would be paying it now.
Are you talking about a guarantor, your mum and dad?
I'm saying mum and dad actually bought the house for us because the bank wouldn't let us.
Ah, okay.
Something like this house
Yes.
would have potentially lowered it enough
Yes.
to service it.
It's to give you that boost. It's that bridge. We're helping to give you that bridge into kind of to get to that traditional loan, I guess, where you're able to have it all, the first mortgage under your name. Yeah, it's that. So our target band is those looking at, because property prices change from state to state. I mean, in West Australia, you could still get away with a $400,000 house, but in Sydney, it's 1.5. Our target band's in that. It's a wide range, but that's your average Aussie looking for houses in that range. So that's who we're targeting. So, yep. Yes. Thanks, Chris.
So if you, say, had the money for a deposit, like a full 20% deposit, maybe even a little bit more, is there still value in going about getting a mortgage this way for a lower interest rate for a portion of time, or is it just not worth it and you should just go the normal way that most people would get a mortgage?
I think that's where you'd want to talk to your financial advisor. What would be better? I would say probably just go the traditional route if you've been able to save up for the 20%.
Okay.
And then you've got that. But you might have plans to do investment properties, and this would be a good way of doing that. You got to think about the wealth generation for the future, I guess. Start thinking about that. When I retire, would it be nice to have 5 properties? So that's where we come in and we can help too. So our clients, once you come in and be part of the shared equity, Storehouse will be in touch with you through an arm of the group called Wealth Garden. And Wealth Garden believes the best way to accrue wealth is property investment. And they'll talk to you about that, set you up for the future. So that, now that you're in you're with us for a minimum term, you should start thinking about what's your future going to look like. What do you want to do? What are your goals as a family, you and your husband or you and your wife? What are you wanting to do? How are you wanting to retire? Would it be nice to have an investment property or 2 by that time? Start thinking long term. We want you to think long term.
Can I just add, so even if you've saved a 20% deposit, sometimes you're not able to service the 80%, so it may be beneficial. So on that case, what we would do is help boost you to that serviceability with the shared equity facility, because right now, with interest rates going up, borrowing capacity is dropping. Yeah.
That's a good point, thanks.
I have a second question because that's actually for a friend who couldn't be here. We definitely didn't have anywhere near enough money to buy our house.
Right.
But my dad helped us buy our house. And so if we were to, in the future, we will one day have to buy him out of his share of our house, would we then be able to kind of refinance or buy him out through this system if we had to?
Yeah, that's the best question.
Or is that a really complex one and we can just talk later?
Yeah, it's a matter of refinancing, so we'd just restructure your current facility into this new facility.
Okay.
Yeah.
Thank you.
Now's the time to ask him. Shoot away. Yes, Cecilia. I think, Bess, you should join me. Come on.
Do I need it?
Okay, thank you. Just wondering, from a super managed super fund, how much is the portion that you need for Storehouse to be able to get a loan?
Ah, all right. Storehouse. We want Storehouse to answer Storehouse questions. Thanks, Chris.
I didn't quite understand the question, so can you? So how much have you got to put in? Is that what you're saying?
Some of our clients come and they only have 80,000 in their super. So
Yeah.
how much do they need to be qualified for this?
Okay. Well, the process is there are always people that come along and they haven't quite got enough, and that's a bit of a negotiation. That's probably the simplest ways. But obviously you run out of money if you do that for everyone. So we do have, as Pete's been sort of indicating, like there is a thing behind the scenes. So when the trust gets spare money, it tries to help some people, and we've been aiming at sort of divorcees, particularly women, and we've done a few deals where they've had no sponsor, and that's the trust sort of saying, well, we'll make a contribution. So there is a bit of a pool of money in the trust, but it's one of these things that as it grows, it's as we said, it's about 200 properties there. It's gone through about $30 million in the trust now. There's a credibility picture in the institutional market. You've got to get to 50 million before you really exist, is probably the best way of putting it. So we're in that growth phase, and we're growing every month, and the word is spreading. So as we grow, we get more resource, and then we're able to be a little bit more flexible. That's probably the best way I can put it. So if someone comes along and they might be $10,000 or $20,000 short, we see if we can help them. Some people go, I can put this in now and I'll put a little bit more in over time because they're putting more into their super or whatever it is over time. So we do something like that.
That might sort of encourage others to move on.
Yeah, well, I think the best way, yes, that's true. And look, there's two things. Like when it was developed, the picture from my point of view was that you wanted your kids to actually stand on their own 2 feet. It's a bridge. It's not, we're going to solve your problem forever. Someone asked a question over there. My uncle bought 3 houses for his 3 daughters. And the famous story is 2 of them got divorced. And he said he had Armageddon. He had 2 come home with grandkids. And, that was his attempt to try and help. And that's the sort of thing that people have got to sort of understand. So when they say, can you service the thing, they're genuinely saying, will you be able to stand on your own 2 feet? And it's kind of like being pushed out of the nest. And so I think there's 2 people at the moment that have gone more than 5 years.
Mm.
And it's up to them. They can go 30 years if they want to. And with the current property market, they might go, well, can we hang in there a little bit longer because it's such a low interest rate? So, I said too much.
Yeah, thank you. Chris, you're getting a workout.
So one of the things with young couples when they get married is they've got their 2 incomes going, they're getting married and they have their early years of marriage. Thank you. They have their early years of marriage and then they want to go into family mode, have kids and all that, and typically that's when you lose an income and all that sort of stuff. So obviously servicing loans is the key thing here. Is there any thought, is there any thought to how that whole thing works for them and any guidance, I guess? But again, I guess you've got to say the financial planner provides that sort of insight.
Yeah, look, I've been through that phase before. I don't think we can really help with that. That's kind of why...
It's a broker conversation. So really when they're going to them, yes, they can service it right now, but they do need to be aware that, yes, if you're going to have kids in the next year or 2, you'll be down to one income.
The broker should be
Your
talking to you.
broker should be talking to you about that. So it's not something that does with them. We assess them at the time. But yeah, they should have a broker and they should have that conversation with them.
All right. Well, that was a good question, but it's about 8:30. I wanted to close about then. If you've got more questions, we'll hang around. Love to answer them. How about we head towards the back? We can answer your questions. And there's brochures back there. Would love if you can, if you're interested and you want to talk to someone more about it, or jump into knowing how much I can borrow, etc., then please put your name and email there. Otherwise, we don't know that you're interested. Oh, Mike, sorry, please come forward. Thanks.
Just want to say a big thank you to Peter and to Beth for being here tonight, and others as well. I thought I would pray, and we would continue to ask the Lord to give us all wisdom as we make some big decisions in the future, or even now, in this area or in other areas. There's always many voices vying for our attention, but remember, we must also come to the Lord and ask for his wisdom. So I'm going to pray, and then indeed we'll continue to have good conversations together. Our Father, we thank you for our time together tonight. Thank you for all the gifts that you give your people, and tonight we just want to thank you for Peter and for Beth and the work that they are doing, helping people into the property market and supporting them as best that they can. Thank you for the presentation tonight. Thank you for the questions that's raised, and we pray now for continued good conversation, and more importantly, that you grant us all wisdom and discernment to know in each of our own individual circumstances what is best. Thank you that you are good and that you provide, and we pray that you continue to do that. In Jesus' name we pray. Amen. Why don't you thank Peter for sharing tonight, and Beth and others as well. There's still some supper there at the back. If you've been watching online, thank you for joining us. Sorry if there were questions online, I didn't see them, and I'll flick them through to these guys and they can maybe we'll work out a way to get those answered in due course. But thanks for joining us.